This is Super Investors in the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
South Northern April 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul Peter Jones.
Peter Lynch. You wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Mark Yusko. And for listeners of this podcast, Mark needs no introduction. I was just a couple of months ago, I spoke with Mark for the show, and we went into great detail about his investment process and his unique approach to the markets. But it turns out that an hour wasn't near enough time for Mark and I. In this episode, we discuss a ton of new material, different topics, Gann and Bradley cycles, and lots of other stuff, not the least of which is a bet Warren Buffett recently proposed and Mark accepted. But I should just let Mark explain it. So please enjoy my conversation with Mark Yusko. And we are live. Mark Yusko, thanks for coming back to the show. I had such a great time the first time that I couldn't help but ask you back again, especially in light of some recent news. So welcome back to the show.
Well, Jesse, thanks for having me. And I have to tell you that, I've been spoiled. We had such a great time last time, and I've done a couple other podcasts, and, I just have so much fun on yours that it's tough for the others to live up to it.
Well, I'm flattered. For me, it's very easy when I have such a brilliant guest to talk to. But I got to ask you right off the bat, you offered to take Warren Buffett up on a very famous bet he made 10 years ago. He was on TV recently again talking about the bet. What's this all about?
Yeah, so here's the interesting thing. Protege Partners, Ted Seides of Protege Partners, made a bet with Warren where Warren would take the S&P and Ted would take a basket of hedge fund of funds, and they put together this $1 million bet for charity. And it launched on January 1st, 2008, coming to an end here January 1st, 2018. And there was a recent article, obviously, talking about the impending end of the bet and basically claiming victory for Warren. And, I think CNBC got on air and said, well, are you interested in taking a new bet? And I think they actually asked him the question because when that article came out a couple months ago saying that, the old bet was coming to an end, I said, well, look, I want to go on record saying I'd like to challenge Mr. Buffett to another bet for the next 10 years because I feel so strongly about where we are in the cycle and why it's so important to get hedged or to focus more on alpha than beta. And they actually even used my tweet in their interview with him last week on television. And so I actually called him that afternoon and spoke with him, and we had a nice conversation. And one of his concerns was that at 87, he might not be around to collect if he were to win. And we joked back and forth that I said I fully expected he would do better than Roy Neuberger, who went in the office every day till he was 94 and managed his own money till he was 101. And he said, "Yeah, my friend Irv Kahn made it to 107." Said at that rate, you could do not only 2.0, but you could do 3.0. So 2 sets of 10 years. And he said he'd entertain my proposal. And so I put together a proposal and I sent it off. And so that's the fun part of the story. And then unfortunately, the not so fun part of the story is literally just before I got on the call here with you, I got an email from Warren saying that, given his age, he was reticent to take another 10-year bet because he didn't think the quality of conversation at 97, would be as high, which, I respect his view. although I think it's the conversation all along that matters, and particularly the conversation right now. So I still think he should have taken the bet.
Yeah, and when I found out that he hesitated and he didn't just take you up on it right when you offered, I thought, well, it's probably because he does agree with a lot of your reasoning for wanting to take the bet. I mean, let's dig into that. Why do you think, hedge fund strategies or certain hedge fund strategies should perform better than the S&P 500 over the next 10 years?
Yeah, and I think one of the things that gets lost in periods of dominance of one style or strategy, whether that's value versus growth, or whether that's long only versus long short, or whether that's international versus developed or domestic, or emerging markets versus developed, is people get caught in recency bias. They think that the fact that long only or index funds or passive have beaten long short or active or more tactical strategies over the past 7 years means that they always will. And what we know from history is that's actually exactly not true. Over the last 40 years, active management has outperformed about half the time, and passive management has outperformed half the time. Now, one of the things, though, Jesse, and this is one of my pet peeves, is there's no such thing as passive management, by the way. Passive is just slow active. The S&P over 30 years replaced 85% of the names in the index. That's not passive. That is active. It's just a committee decides each year who gets to be in the index and who's out. And so the other thing about these index strategies is they're capitalization weighted, which means they're basically momentum strategies. They buy more of things as they go up. And when does momentum work? Well, momentum works when central banks are expanding their monetary policy, and they tend to underperform when central banks are tightening their monetary policy. Well, we've had a 7-8 year period of expansionary, in fact, record expansionary monetary policy. So it's no surprise that index funds came back and won the bet. I think what's lost on most people is Warren was behind on the original bet for the first 5 years, right? Started January 1st, 2008. People forget the market fell 58% peak to trough. And only because of, the super monetary policy of quantitative easing did we have this, high Sharpe ratio, low volatility melt up that we're in right now. So that's a long way of saying that these things are cyclical and that cycles matter. And we'll probably talk later about some other things that cycles matter on. And I think we're at a very, very important juncture where people who buy into the index today are going to suffer very negative returns over the next decade, just like they did in 2000 to 2010. And that's the last time that value was dead, active management was dead, and hedge funds were dead in 2000. When people like Julian Robertson had to shut down his hedge fund because everybody thought he had lost it. And in fact, truth be told, people thought that Warren had lost it because Berkshire was in a 50% drawdown of their own in that period because he didn't do tech stocks. So people don't have long memories. They forget the past and they think that the current environment is going to continue in the future. And I think that's foolish.
Yeah. And you make some important points about passive. And I think that is a great point, that passive is an active strategy, especially when you market cap weight it. I recently wrote a blog post asking, when has any investment discipline or strategy ever become as popular as passive investing is today and had a pleasant outcome? That
would be never, Jesse. Hashtag that would be never.
And so that's what I think about. And then, on the flip side of that, like you said, a lot of these guys are struggling. I mean, Hugh Hendry just shut down his fund. John Burbank shut down his long short fund earlier this year. Whitney Tilson just shut down his hedge fund. Mark Hart shut down his China fund. All these guys that I respect a ton are going through just massive, massive pain in trying to trade, these markets and find opportunities. And everybody who's been passive, feels like a hero. So, just from a sentiment standpoint, this feels very, very extreme, disparity between the two strategies.
Well, it is extreme. And I'll tell you how extreme it is, right? I mean, Warren wrote me this nice letter saying that he'd like to decline, my proposal. And yet the final line of his note says, I am confident that the S&P 500 will beat the vast majority of active managers net of fees over the next decade. Like, wait a second. If you're that supremely confident, then you kind of have to take the bet. And importantly, I think you brought up the point that the hesitation, even in the interview on CNBC, says that perhaps not as confident, yet telling people to buy index funds at near all-time record valuations, where the expected return, according to people like Rob Arnott and Jeremy Grantham and Cliff Asness, heck, even John Bogle said that expected returns over the next decade in stocks are going to be 3 or 4%. That just doesn't seem like a good investment strategy from here. It's not about what happened the last 10 years. It's about what's going to happen the next 10 years. And,
when you take his market cap to GDP measurement, it's almost at a record high. It's just below, I think, the dot-com peak. And when you flip that upside down and look at forward 10-year returns, it's pretty highly correlated. It's not the best, but it has about an 80% negative correlation with forward 10-year returns. And right now it's suggesting, almost negative 3% per year over the next 10. That's his metric.
Yeah, exactly.
Buffett's metric.
Yeah, the Buffett indicator is saying we're going to have negative returns on equities for the next decade. The last time it said that, in 2000, I actually showed that metric as well as a number of others to my board at UNC. And particularly, I showed the forward projected returns from Jeremy Grantham. And my board chair says, Mark, you're not allowed to use the letters G, M, or O in a sentence ever again, because that guy's always wrong. He'll always be wrong. And it's impossible that the S&P could have a negative return for a decade. Well, it did. The next 10 years, the return was minus 1.9, minus 3.5 real. So, you lost about 40% of your purchasing power over the next decade. So we're there again. In fact, if you follow any of John Hussman's work and you see, the median price to sales, where you take out the pollution of the market cap weighting, double counting, the median price to sales has never been higher. And
it's off the chart.
It's off the charts,
yeah,
literally. And you coined the term the everything bubble, that shows that the average investor in this most hated bull market is the most exposed to financial assets they've ever been. And you look at market cap to GDP relative to, again, the median stock, and it's worse than the tech bubble. It's worse than the housing bubble. And this everything bubble is going to end very badly. And, it's really interesting when you step back and try to look at things from a different vantage point or a different perspective. And it's really hard to look at valuations, just pure valuations, look at them relative to history. Oh, but the interest rates are lower. Well, yeah, but think about that. Interest rates are correlated to growth regimes. So back in 2000, interest rates were higher, but so were expected forward growth rates in GDP. So you should pay more for stocks when future growth is going to be high. The myth, in fact, that what Hussman has this great chart that shows of all the data points in the last 100 years, there's never been a data point where the expected future growth is as low as today, plus compared to the PE of the market. And that makes perfect sense. Are low interest rates a sign of economic strength or economic weakness? Think about around the world, where do they have high interest rates? where there's growth. Where do they have low interest rates? Where you have the killer Ds, bad demographics, excess debt, and deflation. So it seems crazy to me.
Yeah, I think, Jim Grant phrased it, really well recently, where he said we have depression era interest rates and boom time equity valuations. It's a huge dichotomy that is very difficult to explain.
Such a great quote. Such a great quote. I'm going to steal that literally.
Yeah. It was very interesting to me for you to say, Warren mentioned his age. I just got to say, I'm a huge fan of Warren Buffett. I owe him an intellectual debt that, will never be repaid. I read all of the Berkshire letters, years and years ago, and he really was, influential in the creation of my process. But I think it's really, sorry, go ahead.
Me too. I agree completely.
Yeah. But I find it really interesting in just the last few years that he has kind of walked away from a lot of what he used to stand for, like value investing and margin of safety and a lot of these things. It seems like he's made a shift. And I do think maybe that's just related to his age and thinking about his legacy and not, he does have so much influence in the markets that if he were ever to turn bearish, he would probably feel horrible about if he did have a personal impact on the markets and people's finances by being publicly bearish. So, do you think that's entered into his thinking at this point?
I think it's a great insight. I think it's a really important insight, and it's interesting because it's the exact opposite of his mentor, Ben Graham. Ben Graham, unbeknownst to most people, but I wrote about this in one of my letters, basically was a go-go Momo investor as a youngster, getting into the business in the roaring 20s. He was all about leverage and momentum and he had a spectacular flame out, losing just about everything, lost most of his clients' money, lost most of his personal money in the crash because he didn't see it coming and he hit the wall with no skid marks, as I like to say. And, what's amazing is it took that incredible loss for him to wake up and really dive deeply into the whole genre of value investing and became ultimately the father of value investing and trained Warren. And Warren went on and built this business around this construct of value investing. And as you said, has now walked away from it and is now pushing momentum investing in the form of index funds for the masses. Although here's the funny thing about that. Everybody talks about Buffett's stock picking prowess and his approach to value investing. That's actually not the genius of Berkshire Hathaway. And I'm not saying he's not a genius stock picker. He may very well be, and I've never really analyzed the data. But the real genius of Berkshire Hathaway is they buy low volatility assets with positive cash flow, and they lever up those assets with negative cost of capital financing because they run an insurance company where they get to borrow with a negative cost of capital. They get paid to borrow money. And so they're levering up the equivalent of the S&P. So they're running a leveraged long portfolio, comparing themselves to, actually they don't compare themselves, but other people compare themselves to a single long portfolio. It's not a fair fight. So leveraged portfolio should outperform, and levering low volatility assets is a genius strategy. So I'm not saying he's not an investment genius. He is, clearly. But it's not the deep value stock picking. And some of the names, like recent things like, Wells Fargo and the home mortgage company in Canada, don't seem, to your point, to be down the middle of the fairway for, what he came into the business preaching.
Yeah. Yeah. And exactly right. And so for me, recently, I guess it was 2 years ago, Carl Icahn, another guy I have just huge respect for and has influenced me a great deal. He hired my friend Jim Bruce to make a documentary called Danger Ahead. And you probably saw it on his website.
I saw it at 12:01 midnight, the night it released.
Yeah. Yeah, and in that video, he says, if more people like me had come out in 2006, 7 and said, publicly what we were seeing and tried to warn people, we probably could feel better about ourselves. And so, I look at Carl doing kind of something different, but then, Warren's probably watching Carl, get completely ridiculed for the past 2 years since that movie, the documentary came out, and thinking, well, I don't want to be, in his shoes now that, I don't know, maybe I just saw it on Twitter, but I thought it was a very appropriate, little documentary about his concerns in the markets, and, people were just making fun of it left and right.
Well,
and maybe
sure.
that's something else that Warren's worried about.
This is Roger Babson all over again. Roger Babson said the market was overvalued in 27 and it went up a lot. And he said it was overvalued in 28 and it went up a lot. And he said it was overvalued in 29 and everybody laughed at him and said, you were wrong, you're wrong, you're wrong. Well, he wasn't wrong. He was just early. And sometimes that's a euphemism for wrong, but he wasn't wrong. And people who would have got out in 27 would have saved themselves a lot of money. People who would have got out in 28 would have saved themselves a lot of money. People who got out in 29 would have saved themselves the most money. And what was amazing is, 3 weeks after he said, I repeat what I said last year and the year before, a crash is coming and it could be terrific. And people laughed at him. And Irving Fisher said, the bears, because they always label us bears if we say anything negative about their beloved markets. The bears are always wrong. And, stocks have reached a permanently higher plateau. We know that was, 2 days before the end. And then we went down 86%. So I think it's not so much the concern about being early or wrong, like Carl has the challenge. I actually think your first point is dead on. I think Warren has a dilemma. His gravitas is so large and justly deserved that if he were to come out and make negative comments or cautious comments, I think it could be perceived negatively, and it could have a reflexive impact, and we could have a lot of people who, look, the average person doesn't have any savings to begin with, generally speaking. Because the wealthy will hold all the stocks and the average investor doesn't have very many stocks. They don't have a lot of money saved for retirement. So their only hope is that the market continues to go up. But hope is not an investment strategy. It's a 4-letter word. And so I do agree with you wholeheartedly that Warren is walking a tightrope, and he actually doesn't have to worry about retirement. He's pretty well taken care of, as are anyone who's invested with him over the years. And I do think, though, now when you look out at valuations, I think to make the comment that he did, he thinks the S&P will outperform active management. If you really believe that, then make the bet with me, because I think he's wrong.
Yeah. Well, I think I used the term before we started recording, false bravado. If you're not going to actually make the bet, then you can't make that claim. So, but the way Buffett is kind of talking about the markets these days also, makes me think about, that Carl Icahn video but it also makes me think about the Paul Tudor Jones Trader documentary where, it starts in early 87 and he's talking about laying the foundation for this trade and shorting, the stock market in the 87 crash. And I think after that came out, he made, I think it was at the time, that was the most profitable trade in history. But But I think after that came out, he probably was embarrassed that he was gloating or, during a crash where he made a ton of money and a lot of other people got really, really hurt. And, Warren seems to me like the type of person he would do anything in his power to avoid being seen that way, and which would just basically preclude him from ever being bearish publicly. So,
yeah, I think it's a very interesting perspective for sure.
Yeah, there's another. But you talk about being early. The difference between being early and wrong, and it's a fine line. And I remember it was almost 3 years ago now. I think Stan Druckenmiller gave the speech at the Lost Tree Golf Club where he talked about, in 2004-05, he was feeling, starting to feel very bearish and worry about what was going to happen to the markets. And it took 2 years for it to play out. He said he was feeling that way again in early 2015, and even, gave a presentation, I think it was at the Sohn conference later that year, about all of these, bearish dynamics at play. And, it hasn't played out that way. But
it did, Jesse, though. Here's the interesting thing. It played out exactly as he laid out. Gold started to do well. Industrial production rolled over. We had 21 months of downward industrial production. I think like 13 months of negative industrial production. PMI rolled over to sub 50, signaling a contraction. There was a depression in the oil and gas industry, and over $500 billion of CapEx got canceled or delayed. I mean, companies went down 85, 90%, and a bunch of companies went bankrupt. I will argue that we were in a recession. And if it weren't for fudging the numbers with an understated PCE, price deflator, we would have been in recession. But what happened is China came to the rescue, just like they did in 2009. Everybody wants to say that the Fed bailed out the U.S. and saved the world, and Bernanke is such a hero. No. I mean, QE was nice, but it was China. China put $4 trillion with a T dollars of liquidity into the global financial system. In late 2015, as we were going downhill, remember the first 2 weeks of 2016?
Oh, yeah.
The market was down 12, 14%. There was panic. Everybody was bearish. The economy was in contraction, I will argue. And China put $1 trillion. And suddenly, we bounced off the bottom. China started buying oil futures. Oil futures recovered from $26. Iron ore futures recovered. The speculative frenzy in the futures market with Chinese capital was extraordinary. And I'll make the case that exactly what Druckenmiller said was going to happen played out. And if not for the PBOC and the ECB and the BOJ, because remember the BOJ, where the year before Kuroda-san had lost his brain and tried to go to negative interest rates, suddenly turned around and started buying assets again. Now they own 75% of all the ETFs in Japan. So there was this coordinated central bank effort to save the world. So do I think they saved the world, or do I think they just, pushed back the ultimate day of reckoning? I think they pushed back the ultimate day of reckoning, and eventually we're going to have a slowdown. And look, I've become, almost as addicted to Sir Isaac Newton as Roger Babson was, that, the third law applies. For every action, there's an equal and opposite reaction. And the longer you put off a correction and a recession, the higher the bubble and the bigger the crash.
Yeah. And I wasn't arguing that Stan was wrong. I think I'm just kind of looking at it as people do, which is he was suggesting a bear market was coming, and now stock prices are higher 2 years later. But it makes me think of a great quote that I got from my friend Bill Fleckenstein's website. It's from Silas Marner. It's the lapse of time during which a given event has not happened is alleged as a reason why the event should never happen, even when the lapse of time is precisely the added condition which makes the event imminent.
That is such a great line. Such
I just think it's perfect because that's what Stan is talking about. He says, I felt this, over 2 years, and he expressed it to people, and then, well, it didn't happen. So, we can forget about that. And I think that's what's going on with Carl and what's going on, with his warning 2 years ago, with Stan's warning 2 years ago. People are like, well, it didn't happen that way, so it's not going to happen. And as soon as people start dismissing it, I think that's where we are right now in this cycle. As soon as people start dismissing it, that's when it's about to happen.
Well, that's the delusion phase, right? And the new paradigm phase is, greed. Everybody just wants to get rich. They got the FOMO, the fear of missing out, and everybody's just piling in. But then you get this delusion that, the market could never go down. And all these bears who predicted it was going to go down are wrong. And that just proves that it can't go down. And then you get to the new paradigm, which is when people say, well, the market could never go down. There was an article that I retweeted the other night where it said, perhaps the market could never correct again. What?
Right.
I mean,
yeah.
And it says, well, the Fed put, the Yellen put. Like, remember, 85% of options expire worthless, and hers will too. The Greenspan put expired worthless from 2000 to 2002. The market went down 50%. The Bernanke put expired worthless. The market went down peak to trough 58% in 2008 and first part of 9. And the Yellen put's going to expire worthless too. But and back to just one clarifying point is I didn't say you were saying Druckenmiller was wrong at all. I was saying the marketplace is saying that he was wrong, but he wasn't wrong. We actually were in a recession. We were in a contraction. We were we were like 1% away from a bear market. We were down like 19% peak to trough or something. And if you look at certain stocks, or certain sectors, they definitely were in a bear market. And so we've had this kind of rolling bear market. But the one thing we didn't count on, and I think, great investors, they can change their mind when the facts change. But what separates a good investor and a truly great investor is a good investor just sells their longs or covers their shorts. But a great investor actually gets short what they were long or gets long what they were short. And that's what Stan did, is the facts changed. China put in this $1 trillion of stimulus. The Norge pension funds suddenly had money to invest because oil prices were recovering again. The Swiss National Bank started buying stocks for some unknown reason. And suddenly you had this 4-sharp S&P. And so Stan got long again. So great investors have strong opinions loosely held. And, I take grief and you take grief. I take a little more grief than you on Twitter about, being so, strident in my views, or how can you say things like that? What if you're wrong? I'm like, well, I'm wrong all the time, but I don't care, right? It's not whether you're right or wrong. It's how much money you make when you're right and how much you lose when you're wrong. That's the paraphrasing of Druckenmiller, who's paraphrasing Soros. So if my ego needed to be right every time, I wouldn't be in this business because it's impossible.
Yeah. And, it's funny to me that it's obvious in almost every other undertaking outside of finance that you have to have the courage of your convictions and be willing to fail in order to be successful. But in the financial markets now with this whole push to passive and everything, it's, no. We don't have to have any convictions and we don't have to put ourselves in a position to fail. We're just going to buy the index. And so anybody who's not doing that isn't entirely criticized, and it's really become a dogma that is gets annoying. But I want to ask you, if over the next 10 years, things are going to be difficult. Hedge fund strategies are going to outperform. Most investors can't invest in hedge funds. So how should the average investor think about the markets and investing if they can't afford to put money in a lot of these different funds?
It's really, really important point. And the good news is there are increasing numbers of strategies that the average investor can take part in. So, HDGE is an ETF that short stocks. It's hedged, as its name would imply. And there are some 40 Act funds of reputable managers out there who've decided to make their strategy available to the average investor who will never be accredited because the SEC has deemed that if you're not rich, you're not smart. That's kind of what the SEC says with accreditation standards, which I think is silly, but it is what it is. It's probably not good to call the SEC silly. I don't mean that they are silly. I mean that rule happens to be silly. But not inviting an auditor.
No kidding.
I think the key is that there are more options for individuals with ETFs and other strategies. It's funny. I've been labeled an ETF criticizer, and that's just not true at all. I'm not critical of ETFs. I love ETFs, and I love ETF strategies that make sense. I am very critical of certain ETFs, like low vol ETFs, which I think is the dumbest thing created in our history, to buy stocks just because of the volatility of their stock price. But certain strategies or certain ETFs where you can get hedged, you can get long short, I think are very, very valuable. And the average investor today, if they're nervous about markets, could actually, be a value investor. Buy what's cheap and sell what's expensive. There are inverse ETFs that you can go short, overvalued sectors of the market. Like, I think small cap stocks are as overvalued as I've ever seen them in my career. The PE is 80 something. In fact, in the Wall Street Journal market segment, or what do they call it, the market dashboard page, a couple months ago, it was actually labeled nil, meaning it wasn't calculable because there were so many companies that were losing money. And if you strip out the companies that lose money, it's only 88 times earnings, which
it's just
doesn't make any
astronomical.
sense. It's astronomical. If you put the companies that are losing money back in, which you should, it goes up to like 800 and something. So you can actually go short that index and go long the S&P, which I think is less egregiously overvalued. I still think it's egregiously overvalued, but less so. Or you could get really creative and you could go long, some portion of the emerging markets. You could go long Japan. You could go long, certain peripheral markets in Europe, which I think are fairly valued. So you can create your own hedged strategy, but buying long and strong index funds that are cap weighted over the next 10 years, I think you're going to destroy a lot of capital.
Yeah, and let's talk about it specifically against, I think Warren has said, put 95% of your money in the S&P 500, just literally put it all in the U.S. stock market. And, two things I think are, and I guess I haven't written about this probably enough, but I think are the bigger risks to investors today. I mean, typically they're not a good idea, but one is home country bias, is not owning enough, diversifying overseas enough. A U.S. stock market is the most expensive on the planet. If you're only going to invest in U.S. stocks, you're taking a ton more risk than you think. But also, most people don't have enough exposure to real assets, I think, either, in terms of just from like a broad asset allocation. Those are the two changes I'd probably make at first to that 95% in the S&P 500. What are your thoughts on that?
Look, the idea of putting 95% of your money in the S&P 500 here at these valuations, suicide, financial suicide. That just makes absolutely no sense. I don't care who's recommending it. That's just a bad recommendation. Your point about home market myopia is absolutely spot on. And it's not just the United States. I mean, the people in the UK have more UK stocks. The people in Germany have more German stocks. People in Japan have more Japanese stocks. And the people in Switzerland have more Swiss stocks, even though most of them aren't Swiss companies. But that's just the way it is. I mean, we all think all the smart people live where we live. We think, we have all the answers in our country. And it's just not true. So most people don't believe me when I say over the last 15 years, Chinese equities beat U.S. equities. Like, that's not true. Like, well, it is. It's just a fact, right? I mean, there are facts and there are beliefs. And people believe things because they have recency bias. And they say, well, the last 7 years, the U.S. was great. Yes, it was. And the last 7 years, up until the last 1 year, because emerging markets have crushed the U.S. this year and most of last year in 16. But in the previous 7 years, from 11 to 16, it was a one-way market, right? The S&P outperformed, emerging markets underperformed because they were heavy in real assets underperformed. But today, as we sit here today, real assets, things, are as undervalued relative to financial assets, paper, as they have ever been in history. And to your point, one of the most prudent things an investor can do today is get real. Own real stuff, own commodities, copper. I mean, copper is such an amazing thing. I mean, I just got back from China, and a couple weeks ago we had our annual meeting for our private fund, and I just did a webinar on kind of travel notes or trip notes. And one of the things I came away from being there, one is the scale and the scope of the growth in China is just incomprehensible to most people unless you go and visit and put your feet on the ground and look up at three, back to back 100-story buildings, which make New York look quaint. And then you talk to people about growth. And, when people get out of poverty, they say the first thing they buy is an air conditioner. And the second thing they buy is an air conditioner for their mom and dad. And the third thing they buy is an air conditioner for their uncle. And because it turns out air conditioning is a really important thing. And try working, where I live in North Carolina in the summer without air conditioning. You can't do it. You can't concentrate. You can't focus. Well, every time you buy an air conditioner, you're taking 11 pounds of metal out of circulation, a lot of it copper. And so the demand for copper is skyrocketing. Throw on top of that all of the transmission wires that have to be put down for things like solar power, et cetera, and all of the electrification that's going on in India. You got huge demand for copper wire. Then you take autonomous vehicles and you put 200 pounds of copper in every new car. Just massive demands for copper. Copper could double over the next 4 or 5 years. And you can take advantage of that in lots of different ways. Same is true. I mean, iron ore is not quite as compelling because the whole Earth's crust is made of iron ore. Precious metals are called precious for a reason. They're scarce and they're interesting here. And then you got the whole industrial metals complex and some of the specialty metals like lithium and cobalt, which, look, if we're ever going to have a Tesla manufactured on a assembly line instead of by hand, I mean, I kind of thought it was a joke when they said they produced 255 last quarter when they were supposed to be producing 5,000 a week by December. It's just never, ever, ever going to happen. But if they were to ever ramp production, there's just not enough lithium and cobalt right now out there. So you got to find different ways to mine it, or the price has got to adjust. So many opportunities in real assets that are really, really compelling. And look, good asset allocation is what drives long-term returns. Buying assets that are cheap and selling assets that are dear over and over and over with discipline is what separates the great investors, the great endowments, foundations, sovereign wealth funds, wealthy families from the other investors. And that's why, if you think about it, why does the average investor, the Dalbar study just came out, why does the average investor over the last 30 years underperform a buy and hold index by 60%? The index made 8 and the average investor made 3. And it's the same reason that they would have lost the bet with Ted Seides that Warren Buffett won, because Warren Buffett wasn't allowed to sell. The average investor would have sold in year 2 when the S&P was down 58%, and they would have missed the rally and they would have lost the bet. No question about it.
And that's just, that's just the sentiment cycle that you see in every single bubble. We saw it in real estate. We saw it in stocks during that time. The dot-com mania was on display through those things. It strikes me when I'm talking with you, and you've written about this too, that, it's kind of just common sense, or it's, largely held that to be a successful investor, you really need to be open-minded. And you talked about how, Stan Druckenmiller is so open-minded that he can, change his mind when, very quickly. You talk about having beginner's mind in helping you analyze different investment opportunities. I think that's something that's really valuable for investors to kind of understand. Can you talk about a little bit about that and maybe how you kind of approach the markets the same way Newton, used the scientific method? You mentioned him earlier too.
Yeah, I think a lot of it comes from, and we talked about this the first time, is my training. I have scientific training as a backdrop, biology and chemistry major in college, and I really didn't know how that applied to investments until I got into investments, and I realized that all of investing is simply forming a hypothesis, testing a hypothesis, gathering the data, reforming the hypothesis. And I have a friend, investment manager, hedge fund guy, who says it best. He says, with every investment, we get richer or wiser, never both. And so you actually don't learn anything when you're right. You only learn when you're wrong. And so you form a hypothesis, you invest, it doesn't turn out. So now you have to reform the hypothesis. And this point about the beginner's mind is so important. And we talked last time about the Dow Jones averages. Dow is TAO for Chinese philosophy. And the key there is that the beginner doesn't have all these biases. They don't have a home market bias. They don't have a bias that, the S&P is the only way to invest. They don't have a bias that, value is better than growth, or growth is better than value, or momentum is better than some other strategy. And so they start with a blank slate, and they form their beliefs the right way, which is you gather the data, you analyze the data, and then you form a belief or you form an idea. Most people do it exactly backwards. They're given their belief, either through the media or from their parents or from, consensus. They then gather data to support that thesis, and worse, reject all the data that's counter to that thesis. Like, one of the things I love about Twitter is, whether you want it or not, you're going to get lots of counter data. And you have to actually,
absolutely.
It's great, right? You have people who just
for sure
give you the other side because they think you're an idiot. And that's very valuable.
Well, and a lot of times the other side is just, you're an idiot. So that's less helpful. But
it's less helpful to just get you're an idiot. I had a guy last night send me probably 20 charts making the case for why, I'm wrong about deflation and inflation is coming. And that was very useful. He had a lot of good, interesting points to make, and I appreciated that. But part of this idea of beginner's mind and mindfulness and all this stuff is daunting to some people. Like, I don't want to meditate. I don't want to be one of those guru guys. It's like, not all about that. What it's about is, if you constantly bathe in consensus, right? If you constantly bathe in the media and all the stories, like right now, the narrative is melt up. Every story you read is about the melt up. So all you're going to believe is that there's a melt up going on, and you have to get in front of it, and you have to buy. Well, what a true investor will do is they will find time for solitude. They will get away from the noise, and they will spend time thinking deeply and reflecting on what they believe based on the data that they see. So what is the data that you see, and how do you interpret it? And then for me, and you mentioned it earlier, that how you make money is by having a variant perception from the consensus. I quoted Mark Mobius earlier today in my webinar, where he said that if you do what everybody else does, you're just going to have average performance. So you had to do something bold and different, like picking up and moving to Asia in 1960s, in order to have a differentiated career, which he has. And I think the same is true here, is if you constantly listen to consensus and think that's the only answer, you're going to have performance that looks like the average. But if you're willing to have variant perceptions, and what is a variant perception? So a variant perception is a view that's materially different than consensus, okay, that if it were to come true, can actually make you a lot of money. And one of my favorite quotes is from Michael Steinhardt that said, we made all our money, all big money, from taking variant perceptions that turned out to be right. Because it's one thing to have a variant perception, but you actually have to be right.
Yeah, it's not enough to be contrarian. And I asked you this. I was reading about something in your latest quarterly letter, and it just struck me as, wow, this guy's just really open-minded and open to a lot of different possibilities. It reminded me of, I interviewed Tom McClellan, was one of the first interviews I did in this podcast when I went up to Seattle, and he's got some indicators that are just, out there. And most people are like, what, you crazy, Tom? But he's not willing to dismiss something just because it looks crazy on the surface. So, speaking of surface, he has an indicator that shows a correlation between ocean surface temperatures and interest rates over long periods of time that he uses. And he doesn't care that, hey, I can't really explain how it works, but it works. And so, you wrote about Gann cycles and eclipses in your latest quarterly letter. And to me, that, kind of really rang a bell with some of Tom's work, which is, comparing natural cycles in nature to cycles in markets. Can you talk a little bit about kind of what you wrote about in that regard?
Absolutely. Look, cycles are so important. And what's really cool about nature is these cycles are so pervasive, and it's everything from the nautilus shell to, circadian rhythms to the cycle of the planets, right? I mean, we know that the cool thing about eclipses is we know to the minute, to the second, when every eclipse is going to occur, for the next X hundred years, because we can calculate, thanks to Sir Isaac Newton, the path of the planets, and we know when the Earth and the sun and the moon are going to be on the same side of the planet. And what's really cool about total eclipses is that the moon, which is significantly smaller than the sun, is precisely an inverse ratio of size to length difference, meaning its distance from the Earth is the inverse of the size difference, so that it perfectly covers. And this was brought home to me because I took my son down to see totality for this last eclipse. And the reason I wrote my letter called Darkness Falls was about this eclipse that was coming up in August. And I thought that was the timing of what was going to happen in the markets and following the 1929 cycle. But it was amazing that in the hour leading up to the full totality, right? The sun, the moon's going across the sun, is getting, smaller and smaller of a sliver. And then suddenly, like a light switch, it's dark. And literally went from, bright daylight to darkness, and for 2 minutes and 41 seconds. And the most amazing thing to me was literally 1 second later, it was fully bright again. So just that littlest sliver of the sun was enough to illuminate the whole world, which was kind of wild. So the fact that the two heavenly bodies could be that perfectly aligned to cause this total eclipse is just kind of one of those cool things in nature that we have to pay attention to. But what I loved about eclipses and cycles is that human beings make up markets, and human beings don't operate on cycles. They don't operate on rationality. They operate on emotion. And so, here we have Sir Isaac Newton, one of the smartest men ever in our life, in our world, not our lifetimes, but in our world, who got caught up in the South Sea bubble and lost everything chasing a hot stock because the price was going up. His only reason for buying it was because the price was going up. Wait, that sounds familiar. People say that now. The reason to buy stuff is because the price is going up.
Right.
And the key is that he said, I can calculate the movement of heavenly bodies, but I can't predict the madness of people. And so that got me to dive deeper into cycle research. And I've always been a believer in this idea that the lunar cycles and the solar cycles and the seasonal movement of the stars and the planets actually has an impact. And And the reason I believe that is when I was growing up, I thought I wanted to be a doctor, and I worked in an emergency department. And, one of my first nights in the emergency department, we had a full moon, and we had 10 times the number of patients that night. And so I asked the nurse, I said, what the heck's going on? I said, oh yeah, it's every full moon. I said, what do you mean every full moon? So yeah, people go crazy on full moons. And then I got married, and it turns out my wife doesn't sleep very well when it's a full moon. I mean, it actually physically impacts her. Same with my daughter. And so I started doing research into this. And there are a couple of people, this W.D. Gann, who wrote this study in the 1900s, early 1900s, where he calculated all the relationships of these big cycles that had occurred over time. And then he laid out in very specific detail for the next 100 years what would happen based on these ideas of cycles of highs and lows in markets over different cycles, 16-year cycles and 60-year cycles and 80-year cycles. And he actually predicted things like the crash in 87 and the crash in 2008 and the recession in 1991 and all these things that lined up perfectly with these cycles. And you dig deeper into it and you're like, wait a second. And then I also knew that people like Paul Tudor Jones and Louis Bacon and Stan Druckenmiller were really serious disciples of not only Gann, but of this guy, Bradley, and the Bradley, what the heck is that thing called? I just ran out of my head. Siderograph. So this guy Bradley wrote a book in the 50s talking about how, again, these lunar cycles have an impact on human behavior and that markets would fluctuate around certain days of the year. And again, he laid out this, for the next 70 plus years. And, Paul and Lewis and these guys would use these cycle dates, or what are called Bradley turn dates, as an indicator of when cycles and things would turn. And I'll give you a great example. So, listeners can go check this out. So turn dates, and both Bradley turn dates and Gann dates are similar. There's a Gann date every 3 months, usually around the 21st or 22nd of the month in each quarter. So a March, a June, a September, and a December. And there was a Gann turn date on June 22nd. So pull up charts of Russia and oil and a couple other things related to hard assets that had been trending down all year. And look what happened on June 22nd. And we just came to another turn date on September 22nd. And you can see a number of patterns that had been strongly trending one way suddenly turned, the dollar being the most notable. So trends tend to change on these turn dates, and they have to do with cycles and research. And when I talk about this, some people say, that's just absolutely ridiculous, right? How could the moon and the sun and the stars have an impact on markets? And well, if they impact humans make up markets, and I think they're going to have an impact. So it's one thing to use in addition to other things. And but I think something I believe.
And I applaud your open-mindedness in this regard, because I've gotten trashed because I sometimes pull up analogs of previous market patterns, and you look at 1, 2, 3 year pattern of the market, and you have a 96% correlation to today's pattern. That's pretty interesting. That's one of the tools Paul Tudor Jones used to predict the 87 crash. I think I remember Jim Rogers used it, the 1937 analog, when he traded the 87 crash. And so all these things are just tools. But speaking of that, are there specific books or things that you learned to or used to learn about Gann and Bradley?
Well, there are a couple good biographies on both of these guys, and I read excerpts of them. The nice thing is they're actually online. You don't even have to buy the book. You just they're on whatever that big is, a Google library or whatever that puts all the books up. And so I read a little bit of the biographies. There's also a website I think it's called the Cycles Institute. I should know the name of it, but I think it's called the Cycles Institute. And it talks about a lot of the history of GAN in particular. In terms of Bradley, that there's a whole bunch of stuff on him because it's a little bit newer and a lot of there I just picked up off websites. One of the fun things about going to these websites is it's the intersection of astrology, numerology, philosophy, and a whole bunch of esoteric stuff that people don't really like. And another one that I do pay attention to, that again some people think I'm crazy. I pay attention to the Chinese New Year and the animals that dominate that particular year. And there's certain years that are more vulnerable than others, and so there's a guy, Paul Wynn, I think that's how you pronounce it, NG is the last name, and he's a famous astrologer. And every January, I make sure I read his forecast for the year, and he is uncannily prescient in how he lines up things that have to do with Chinese New Year and the lunar cycles, et cetera. So there's a lot of different ways to incorporate this. And there's actually a cool piece that I stumbled across when I was doing research on GAN and actually on Roger Babson. There's another guy, I can't remember his first name, but Benner. Is it Samuel Benner, Benner. And he wrote a book in the late 1800s about commodity cycles. And I think that book kind of circulated amongst these guys as well. But again, he predicted things that would happen 30, 40, 50, 60 years later with amazing prescience. So, but there are a lot of resources out there. But one thing I stumbled across is when I was looking at W.D. Gann's work, is I came across the letter that he issued in November of 1928, where he basically predicted the whole year of 1929, from the March low to the June low to the September peak, and then the crash after that. And along with that, in his supply and demand letter, he had a reading list. And it's a little tough to make out because it's like a scan of an original document, but there are some amazing books on numerology and astrology and things that if you really want to dive into this stuff, there's some interesting stuff out there. But to dismiss something either because you don't understand it or you have a bias against it, I think is short-sighted. You may not want to incorporate it and live by it. But it's like the people who follow Japanese candlesticks or the people who buy or DeMark indicators. They're all proven to work in certain scenarios, and they're all proven to work with other parts of a broader analysis. And I believe in, I don't know if I coined this term, but I believe in technomentals, the combination of technicals and fundamentals, and just copying what the greats did, which is kind of how I live my life. So Soros looked at him, Druckenmiller looked at him, Paul Tudor Jones, all these guys who have done really, really well in their careers and lives as investors, all believed in this stuff. So it's probably good enough for me. Yeah.
And I've done the same. And they're all just, I think there is no holy grail, but they're all tools that have their uses. And, you can't build a house with just one tool. You need to find a good combination of tools to get them done. Exactly. But I'll put up a bunch of these links and stuff and resources when I put on thefelderreport.com. I'll put up a post for this podcast. But Mark, I'm really grateful to you for sharing your wisdom like this. That was a blast. Thank you very much.
Well, look, I always have the most fun, hashtag big fun when you and I get together and talk. You are one of those unique interviewers that can take me down paths I didn't imagine when we start the interview. And you keep the conversation really turning back new pages and new layers rather than just the surface sound bites that aren't really helpful to people. So thanks for having me on. Thanks for being nice enough to have me back probably too soon. So don't want to be overexposed, so to speak. But I really,
not at all.
enjoy I really enjoyed talking with you and hope the listeners enjoy it.
I think we could do it, 3-4 more times in short order and still not cover everything we want to cover. So yeah, it was awesome. Thank you very much. We'll do it again.
Thanks, Jess.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. For links and charts and a bunch of other stuff that Mark and I talked about during this episode, visit thefelderreport.com/podcast. Thank you for listening. And until next time, buy low, sell high.
Looking good, Billy Ray!
Feeling good, Lewis.
Man looks in the abyss. There's nothing staring back at him. At that moment, a man finds his character. And that is what keeps him out of the abyss.